Are we on the brink of another banking crisis? Fears surrounding regional banks are sending shivers down Wall Street's spine, triggering a market sell-off and leaving investors scrambling for safety. But here's where it gets controversial. Are these fears justified, or are they an overreaction driven by market jitters? Let's dive into what's happening. As Thursday night unfolded, U.S. stock futures pointed slightly downwards, a direct consequence of the previous day's market decline. This sell-off was primarily fueled by escalating concerns about the lending practices of regional banks. To put it into perspective, futures tied to the Dow Jones Industrial Average slipped by approximately 102 points, translating to a 0.2% decrease. The SP futures and Nasdaq 100 futures experienced even steeper declines, both falling by more than 0.3%. These figures paint a clear picture. Unease is permeating the market. In after-hours trading, several companies experienced notable movements. Interactive Brokers Group, for example, saw its stock price fall by over 2%, despite reporting strong quarterly results. This might seem counterintuitive, and it highlights the complex interplay of factors influencing market sentiment. Oracle, the cloud computing giant, also slipped more than 2% after analysts reviewed its long-term financial outlook. What's interesting is that Oracle confirmed a major cloud deal with Meta at its AI World Conference. So why the drop? And this is the part most people miss. The pharmaceutical sector also felt the pressure. Drug makers Eli Lilly and Novo Nordisk both moved lower after President Trump, during a briefing on fertility treatments, suggested his administration was negotiating significantly lower prices for their blockbuster obesity drugs. This illustrates how policy announcements can have an immediate and tangible impact on specific industries and the broader market. Wednesday's trading session painted a similar picture of decline. Each of the major U.S. industries' stock indexes closed in the red, primarily driven by a substantial drop in bank stocks towards the end of the day. The Dow Jones Industrial Average lost 301.07 points, 0.7%, while the SP 500 and the Nasdaq Composite settled down by 0.6% and 0.5%, respectively. These losses underscore the pervasive nature of the market's anxiety. Specifically, shares of several financial heavyweights and regional banking institutions experienced declines after Zions and Western Alliance disclosed problematic loans. These disclosures ignited concerns about potentially lax lending practices within the sector, then sparked fears that similar issues could be lurking elsewhere. The SPDR SP Regional Banking ETF, KRE, which has been trending downwards for 4 consecutive weeks, plummeted by more than 6% during the session. This sharp decline underscores the severity of the concerns surrounding the regional banking sector. Adding fuel to the fire, the recent bankruptcies of 2 auto industry-related companies have further heightened anxieties within the banking sector. Volatility also reared its head. Wednesday witnessed a surge in the SIBO Volatility Index, VIX, often referred to as Wall Street's fear gauge. Simultaneously, Treasury yields and the U.S. dollar experienced declines. On the other hand, gold prices reached new record highs, suggesting that investors are increasingly seeking refuge in safe haven assets amid the prevailing uncertainty. Liz Ann Saunders, chief investment strategist at Charles Schwab, offered her perspective on CNBC's Closing Bell. She pointed out that the banking concerns are surfacing at a time when there's a considerable amount of speculative froth in the public market, with investors actively pursuing stocks with riskier profiles, such as those in quantum computing, drones, and unprofitable tech companies. This froth, she argues, makes the market more susceptible to volatility when confronted with broader economic concerns. When you have that speculative froth and then you have sort of a bigger picture potential issue, those two can sometimes collide and cause an increase in volatility, Saunders explained. She further noted that this speculative activity is largely concentrated in smaller pockets of the market, such as the Russell 2000 index, which ironically hit a fresh high on Wednesday. So, is this a sign of underlying strength or a dangerous level of complacency? Adding to the market's woes, persistent tensions surrounding global trade and tariff policies, elevated market valuations fueled by the artificial intelligence boom, and the ongoing U.S. government shutdown continue to cast a shadow. The shutdown, now in its third week, has led to the indefinite suspension of crucial economic data releases from federal agencies, further complicating the task of assessing the market's true health. Despite the recent turbulence, the S&P 500 is still up nearly 1.2% this week, largely thanks to a strong start to the third quarter earnings season. The Dow Jones Industrial Average has added approximately 1% week to date, while the Nasdaq Composite has gained 1.6%. This highlights the conflicting forces at play in the market, while underlying economic concerns are weighing on sentiment. Positive earnings reports are providing some degree of support. Movers and shakers in after-hours trading. Several companies made headlines after Thursday's market close. CSX Corporation. Shares of the railroad company jumped 2% following strong quarterly results. CSX reported adjusted earnings of 44 cents per share on revenue of $3.59 billion for its third quarter, surpassing analysts' expectations. However, declining coal prices and merchandise volume led to slightly lower revenue during the period. This illustrates that even positive news can be tempered by broader economic trends. Interactive Brokers Group, despite reporting better than expected earnings and revenue, the stock fell nearly 3%. The company's adjusted earnings of 57 cents per share exceeded analysts' forecast of 54 cents per share. Revenue also came in higher than expected. The global electronic broker reported a 21% jump in net interest income, driven by stronger securities lending, higher average customer margin loans, and credit balances. The question here is, why the negative market reaction despite the positive results? Oracle, shares of the cloud infrastructure provider, fell 2.4% in after-hours trading after it provided analysts its long-term financial outlook. Oracle expects its revenue will rise at a 31% compound annual growth rate over the next 5 years. The company also highlighted the growth of its core database and data platform business and announced a cloud computing deal with Meta. The market seems to be uncertain about Oracle's very optimistic 5-year growth projection. U.S. stock futures opened with little change, suggesting that the market is currently in a state of cautious observation. So, what do you think? Are these banking concerns overblown, or are they a legitimate threat to the market's stability? Is the speculative froth Liz Ann Saunders mentioned a ticking time bomb? And will the government shutdown further exacerbate the situation? Share your thoughts in the comments below. Let's discuss.